Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
All right, we've got three big stories for you today. First up, we're diving into how the arrival of US Bitcoin ETFs is shattering the crypto world's predictable 4-year cycle. Then, we'll look at a looming deadline for a $7,500 EV tax credit that's fueling a record sales frenzy, but might lead to a market collapse on October 1st. And finally, we'll break down Reddit's spectacular comeback and how its new AI tools are shaking up a digital ad world where giants like Meta are building untouchable empires. Get this. The predictable 4-year cycle that has governed Bitcoin for a decade is now showing signs that it might be completely broken. For years, the pattern was simple. A halving event would cut the supply, a massive rally would follow, and then a brutal 70 to 80% crash, ushering in a devastating crypto winter. And that's a huge deal because that halving event directly slashes the revenue for the Bitcoin miners who secure the network. The most recent halving, for example, cut their reward for validating a block of transactions from 6.25 Bitcoin down to just 3.125. In the past, they could count on the price skyrocketing after the halving to make up for that loss. But if that rally is no longer guaranteed, their entire business model is at risk. We're already seeing a massive shift with mining companies forced to consolidate just to survive, and some are even diversifying into totally different fields like providing data centers for artificial intelligence just to stay afloat. But this time, the script was flipped. Bitcoin shattered its all-time high of over $73,000 before the A halving, a move that has never happened before in its history. The core reason? A flood of new money from US approved Bitcoin ETFs, bringing in deep-pocketed institutional investors who are fundamentally changing the market's DNA. One research analyst noted this was the first clear sign that institutional flows could alter traditional cycle dynamics. So what's the mechanism that makes these ETFs work? They have special players called authorized participants. Think of them as the market's mechanics. Their job is to create or redeem large blocks of ETF shares by exchanging them for actual Bitcoin. This whole process is what keeps the ETF's price almost perfectly pegged to Bitcoin's real price. It effectively bridges the gap between the wild world of crypto and the structured world of traditional finance, creating a more stable foundation for the price. This isn't just about timing anymore. It's about a power shift in who owns Bitcoin and why. The chief investment officer at Bitwise Asset Management put it bluntly, telling CNBC, "I think the 4-year cycle is over." So, are the catastrophic portfolio destroying crashes a thing of the past? Experts are saying yes. One told CNBC, "We believe the era of brutal 70 to 80% drawdowns is behind us," suggesting future corrections might be closer to 30 or 50%, not the massive pullbacks of old. However, if you zoom out, you'll see this shift introduces a new kind of black swan threat. Before, the risk was a market panic among individual investors. Now, with billions of dollars in Bitcoin being held by just a handful of large custodians for these ETFs, we have new single points of failure. A major hack on one of these custodians or a technical failure in the ETF financial plumbing during a crisis could trigger a systemic event that we've never seen before. While volatility isn't gone, the game has clearly changed. And this has a massive ripple effect on the entire crypto ecosystem. Historically, money would flow into Bitcoin first and then rotate into the thousands of smaller cryptocurrencies in what was called an altcoin season. But that's not happening this time. The institutional money coming from ETFs is hyper-focused on Bitcoin and Bitcoin alone. In fact, research shows that a staggering 85% of crypto fund inflows are being directed exclusively to Bitcoin. This is leaving many altcoins starved of capital, raising the question of whether they can survive if they are permanently decoupled from Bitcoin's success. So, while the old rules in the crypto world are being rewritten, let's shift gears to the auto industry, where a government policy decision is about to send the electric vehicle market into a tailspin. A $7,500 federal tax credit for EVs is set to be eliminated on September 30th, and it's triggering a full-blown consumer frenzy. The result? Consumers purchased nearly 130,000 new EVs in July, the second highest monthly sales tally on record. The market share for electric vehicles also hit a record 9.1% of all passenger vehicle sales that month. But this massive policy-driven sales surge raises a critical question that often gets overlooked. What does this actually do to our infrastructure? It creates what experts call a demand shock. Research from the National Renewable Energy Laboratory shows that even a modest localized cluster of new EVs can overload neighborhood transformers if everyone charges at the same time. Utilities and charging networks may not be prepared for this artificial boom, which could expose critical bottlenecks and degrade the charging experience for everyone. And it's not just the usual market leader. While Tesla's sales have declined for 2 consecutive quarters, other models are surging. The Chevy Equinox EV sold 8,500 units in July, the highest monthly total in the US for any model outside of Tesla. This rush is all about the numbers. The tax credit brings the average new EV price down to around $48,000, achieving near price parity with a traditional gasoline car. One analyst at SP Global warns the disappearance of the credit jeopardizes that price competitiveness. Now, on a global scale, this isn't just about the US market. Believe it or not, removing this subsidy could be an unintentional gift to Chinese EV manufacturers like BYD. What many might not grasp is the scale of the advantage here. Analysts estimate that Chinese-made EVs already cost about 30% less to build than their Western counterparts, largely because China dominates the battery supply chain. So while this policy makes American-made EVs more expensive at home, Chinese brands are positioned to expand aggressively everywhere else. But the story gets deeper. Dealers are adding fuel to the fire, offering an average of nearly $10,000 in additional financial incentives. That's a staggering 17.5% of the average transaction price. But where is all that incentive money actually coming from? It's not magic. Research shows these massive incentives are primarily coming from the manufacturer's margins, not the dealer's profits. Automakers are essentially buying market share. For example, GM saw a 114% sales surge after offering huge rebates. But this is a high-stakes gamble on their long-term financial health, especially once they can no longer rely on the government to cover the first $7,500 of the discount. This all leads to one major question. What happens on October 1st? One senior analyst at Cox Automotive put it bluntly, predicting that once the tax credit expires, EV sales are likely to collapse in the fourth quarter. And a collapse like that isn't just a number on a chart. It forces legacy automakers like GM and Ford into a brutal strategic corner. Do they pivot to hybrids? Do they absorb massive losses to keep prices low? Or do they pull back on their EV investments altogether? One analysis projects that repealing these credits could put 130,000 direct American jobs in the EV industry at risk by 2030, threatening the country's entire competitive edge in the clean energy race. It's a tough road ahead for automakers, a real high-stakes gamble. Speaking of which, while some companies are bracing for impact, one platform that many had written off is having a remarkable comeback. The most unexpected comeback story in the tech world today has to be Reddit. This is a company that saw its shares plummet over 15% earlier this year, but has now, in the words of one analyst, rose back like a phoenix. Reddit just posted a blockbuster quarter with sales exploding 78% year over year to $500 million, sending its stock soaring as much as 20%. And the key to this turnaround was a fundamental change in their game. They rolled out new AI-powered advertising tools that gave marketers what they crave, a direct line to authentic conversations. We're talking about an 84% surge in ad revenue alone, driven by features that let brands analyze trends in real time and even showcase positive user comments right under their ads. It's a masterclass in turning community into cash. This comeback story is unfolding in the shadow of an even bigger war, an AI arms race dividing the digital ad world. On one side, you have the Titans. Meta CEO Mark Zuckerberg credits AI for greater efficiency and gains that helped drive a 22% sales jump, hitting a staggering $47.52 billion in a single quarter. So when Zuckerberg talks about greater efficiency, what are we actually looking at? We're talking about AI systems like Meta's Advantage Plus campaigns. This isn't just about better targeting. It's a fully automated engine that analyzes billions of data points to predict who will buy, automatically adjusts bids, and even dynamically changes the ad itself. The results are just staggering. Advertisers using these tools are reporting a 32% increase in their return on ad spend. Both Meta and Alphabet are now doubling down, with Alphabet adding an extra $10 billion to its capital expenditure forecast, now pegged at $85 billion for 2025. These massive investments are creating what experts call a competitive moat, an advantage so vast and expensive that smaller platforms simply can't cross it. But on the other side of this arms race, the ground is shaking for smaller players. Snap's second quarter sales grew by a comparatively weak 9% after a botched update to its advertising platform. To put that botched update in perspective, a technical glitch essentially caused their ad platform to sell ads at a massive, unintentional discount. It highlights just how fragile these multi-billion-dollar ad systems can be. Meanwhile, Pinterest shares sank over 10% after it missed on earnings per share. Unlike Meta, Pinterest finance chief confirmed that Asian-based e-commerce retailers pulled back their spending, underscoring how advertisers flock to the biggest platforms during economic uncertainty. What really brought this to a head, though, isn't just about the economy. There's a huge geopolitical story here. The US recently revoked a trade loophole called the de minimis exemption, which allowed companies like Shein and Temu to ship goods under $800 to the US duty-free. With that loophole closing, those e-commerce giants are slashing their US ad budgets. Meta's global reach makes it a safer bet for the ad dollars that remain, while smaller platforms like Pinterest feel the pullback much more acutely. And the plot just thickened. In a formal regulatory filing, Snap has officially added Reddit to its list of competitors, signaling a new rivalry is just beginning. It's a tale of two markets. One where AI-powered giants are pulling away, and another where the slightest error can be fatal. As one e-marketer analyst put it, for these smaller tech firms, there's very little room for mistakes or missteps. Ultimately, it shows that in this new AI arms race, the ultimate weapon isn't just smarter algorithms, it's access to capital.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.